right, good evening everyone and welcome back to another episode of SFN, Startup Financial News. Today is July 22nd, 2019. I'm your host, Julien Meyer. And folks, today we're doing a special show here on the program. If you're tuning into the podcast, you'll notice we're missing the What You Need to Know and today's top headline sections. And we're going to be doing something we've done in the past. If you're watching us on YouTube, this is going to be similar to our Saturday special episode, which if you're just joining us, was this past Saturday, where we're going to be covering a featured topic. Sometimes on this program, much like in a traditional news day, there's a story that's just so important that it's the only thing that has to be covered that day. It's the one thing that we have to talk about more than anything else. And so to not take away from that, we do these special feature episodes when a story warrants that kind of attention. So today, we had a very, very, very interesting story that broke at the close of the market today via CNBC. I'm going to go ahead and read the subject line for you, if you will. Equifax settlement, venture-backed bubble, ? Elizabeth Warren's recession scare. The piece in that subject line we're going to be discussing is the venture-backed bubble, okay? So again, this is from the CNBC Evening News Brief note under the editor's notes section, okay? And what this story talks about first is WeWork's valuation, goes into a couple different metrics, and then finally kind of concludes with this whole question more than anything: are we in this venture capital backed or created bubble? So I want to highlight a few excerpts from the story. I'm going to start with just the first paragraph and just, let's go ahead and listen clearly here to what the CNBC editor is saying, which is, quote, actually, let me give you her name real quick. Kate Rooney, CNBC Markets reporter, is the one who is responsible for publishing the story. So again, first paragraph, quote, from WeWork's eye-opening $47 billion valuation to Robinhood's new $7.6 billion price tag on Monday, it's hard not to wonder if private markets have entered an all-out bubble. According to a new PitchBook report out this week, spending sprees by venture capital and private equity investors that lift these startups' values are nowhere near slowing down. Folks, this is a narrative that we have not yet heard. We've had inklings of this in the Wall Street Journal. We've had pieces that we've covered on this program in the mainstream in the mainstream media, from the mainstream news outlets that have touched on this topic, but nobody that has flat out come out and said what we've been saying on this program for almost a year, that wait a minute. Valuations are through the roof. PE ratios are through the roof. VC investments and spending through the roof for no significant reason. And now finally, from one of the most respected, trusted business news organizations in the world, probably in one of the most important newsletters of my day, that should be of your day, probably of any investor's day, we finally have this mind-boggling, unbelievable story that has just somehow slid into our inboxes. Folks, this is incredible. This is something that nobody has wanted to bring attention to. And let me explain to you why it's so incredible. When you have any kind of bubble, what ends up happening is you start in some kind of rationale. You start somewhere at a point where there's actual good business being created, there's actual revenues or profits being generated, there's actual business plans, there's actual opportunity, right? There's a path forward. Then as this bubble starts to flourish, what happens is you have new market entrants. Right, you have the wannabe entrepreneurs, right? Not the ones that are doing it specifically because it's in their lifeblood, but because they see, wait a minute, this is a way to get rich quick and not have to work, a 40-hour work week for somebody that I don't like, right? So they come into the market. Now, when they come into the market, then you have, slowly but surely, this finance arm, which is a little bit slower to move, but where they start to see, okay, wait a minute, something's going on here, something's hot, I want a piece of it, I want a piece of it, I want a piece of it, I want a piece of it. That's Wall Street. And I love them for it. Right? There's nothing wrong with that. That's free market capitalism. It's a part of our way of economic life. Okay? But what ends up happening is they start to come in and they start to bring in these boatloads of capital that they want to deploy. And they have to find ways to deploy it effectively. They have to find ways to deploy this capital so that they can generate a return for their shareholders. So what they do is they start to, work all the mathematical formulas, they look at their Excel sheets, and they figure out some kind of investing thesis that works for them. So they put this money to work. So what happens is they become slightly more agnostic than the original investors, right? Remember, we started with the original marketplace, which was the really good entrepreneurs and the really good investors that saw something, understood it, want to bring it up. And then you kind of have the hacks and the wannabes that come into the space on both the entrepreneur side and on the finance side. And I don't use that. I know it comes across as a derogatory term. I'm not intentionally trying to discredit anyone, because if you're an entrepreneur that can you come in, you see the opportunity, you can raise a crazy amount of capital, scale the company, IPO it. Good for you. Better than me. I've never IPO'd a company. Good for you. Right? No judgment there. But it remains that we have to discuss the fact, right? We have to discuss what's going on here, because the truth of the matter is that this is kind of how these bubbles are created. So you're still kind of okay at that level. But then there comes this inflection point where you have so much saturation in the marketplace. You have so many people playing in it that it seems that there's almost less ways to create that value, right? Both on the entrepreneur side and on the venture capitalist side. So we start to see kind of these, what we've been calling scratch your head metrics and financials for a period of almost 2 years now, where you start to just kind of wonder, things don't sound right. Right? You read reports, you look at filings with the SEC, you look at companies that are recently going public. You get a story like WeWork's Adam Neumann, who's selling close to $1 billion, of shares pre-IPO, which is very strange. A huge signal that seems to have no faith in the company. Right? I mean, you start to hear these stories, and it's like, well, what the hell's really going on here? Right? And it kind of makes you think, okay, well, at the top of a bubble, at the height of a bubble, what happens is you have this market euphoria. You kind of have this total misunderstanding, this total dysfunctional, if you will, way of thinking that says, oh, well, this will go on forever. Right? And the thought process today is, well, the internet is here, it's still new, it's still young, it's changing how everything is done in the world. I'm sorry, we don't need another Facebook, okay? We don't need another Uber. And even those two things, really, that innovative, let's be honest. Let's picture a world pre-Facebook, pre-Uber. Not that much different. Not that much different than the world we live in today. Very weird to think about, right? And a lot of you are going to fight me on it, and I know it. But think about it. You could still get a cab. I could still call car service. Without Facebook, I could still send pictures via iMessage today. Right? I could still share them on Flickr. If anything, I'd probably have more privacy. So think about that. That the two biggest unicorns, right? Two of the biggest unicorns, Uber and Lyft, really haven't, as far as overall kind of standard of or quality of life for human society, have pushed the envelope that far forward. Now, yes, it's a little far-fetched. It's a blanket statement to say they haven't done anything. They've done a lot. They contribute a lot to the economy. They create a lot of jobs. But the truth be told, compared to something like flying cars, right? We're not there yet. I think one of the greatest quotes that I've heard, and I apologize, I don't remember who the technologist is that said this, but there's a famous technologist or investor who says, we were promised flying cars. They were saying this in the early 2000s, about this time period, about 20 years later. He said, we were promised flying cars by 2020. Instead, what we got is 140 characters, referring to Twitter. And I thought, wow, what a powerful statement, because it's so true. And it just starts to make you wonder. You start to look at all these different unicorn apps, all these different, massively valued companies, right, that are just completely overvalued. You start to wonder, wait a minute, and even underneath, forget the fact that they're overvalued. Let's just look underneath, too. How innovative really is this product? It's strange to think about. I don't have a better way of putting it. And the other thing that comes to mind, probably my least popular opinion amongst my Silicon Valley colleagues and people that I work with on the West Coast, is and we use Slack, just as a disclaimer, just like we use WeWork. We can pontificate about them all day long, but we're customers. We're going to use them while they're in business. We use Facebook for different things, all that. So just to be clear, but one of the things that we find so interesting, especially within our organization, both at Startup Financial News and at North Star, the financial services firm that I run, is a company like Slack, which, very unpopular opinion, is basically a glorified AOL Instant Messenger, right, combined with some email. Okay, it's a chat room. Okay, and the things that they've done in terms of the integrations and sharing files, sure, very innovative. But the true innovation, really the true innovation, what makes Slack a $26 billion company is still kind of a scratch your head metric or company for us. It's still slightly off. There's still something there that doesn't make sense. We can't put our finger exactly on it. Right? I'm not going to sit here and do a 45-minute video going through Slack's, financial reports and statements, say, oh, well, here, this is bad, because every finance professional in the world can do that. It's more of a looking at it as a whole, right? Even as an outsider, even as someone that's not in the world of finance and saying, well, that's a good point. It is kind of like an AOL Instant Messenger. Why is it worth so much? And it's just those kinds of questions. It's those kinds of questions, folks, that have led us to, these discussions we've had over the past 2 years on the program of calling companies out that are very easy to call out and of calling out this bubble, because when you hit this height of this bubble, what ends up happening is you start to ask these questions. Normally, these questions wouldn't pop up, but these questions, they're strange because they seem so out of context and they're so opposite of what everybody else is saying that it makes you wonder, oh, wait a minute, there could be something wrong here. And so to get back to the point of what we're trying to talk about, we talked about how a bubble kind of starts with somebody finding a good market, a good industry, a good whatever, and then getting to this inflection point where you have kind of the hacks that are jumping on both sides, the people that want to ride the gravy train, and then it gets to this euphoric state, this total misunderstanding, this total dystopia, if you will, about the situation where, folks are going crazy when it comes to how they value companies. Folks are going crazy when it comes to how much money they're raising for companies. When we're going crazy with PE ratios. When we're letting companies slide. When we're letting a company like Uber go public when they say they may never be profitable. Right? When we're looking at these things, and of course there's the financial arguments that say, oh, well, it's okay, Amazon did it, whatever, fine, but let's cut the crap. Right? How many Amazons actually make it? Right? It's the same thing that I learned growing up from my father, which is the survivor bias amongst hedge fund managers. Right? You only ever hear about the good hedge fund managers, which makes you think, oh, wow, what a lucrative career choice. But how many names do you really know of hedge fund managers? 5, 10? How many hundreds fail each year? Each year. It's the same kind of thing. It's the same kind of issue with referring to every company today as, oh, it's okay because Amazon did it. You just can't do that. It doesn't work. Because the greater majority will fail, have failed. It's the world we live in. And so, again, to get to this bubble, to get to where we're at this stage where we have the euphoria, we have the misunderstanding here, and we have a problem that is so big that we can't stop it right now. And when I say it's so big, in the CNBC letter today from the editor, there is a section that discusses the amount of capital that's been raised this year to date, which, let's see, I'll read it for you folks. Quote, by the end of last year, PE and VC managers let me start that over. Quote, by the end of last year, PE and VC managers amassed a total of $3.3 trillion in assets under management, or AUM. Roughly a third of that is so-called dry powder, meaning capital is raised but not yet invested. That means we have $1.1 trillion, trillion, right? Not billion, trillion, $1.1 trillion that has to be deployed by these managers. That's a scary thought, because what are they going to do? They need to deploy this capital in order for them to generate their paychecks, right? And these are finance people. They care more about their paychecks than they care about anything else. They're not like the Silicon Valley technologies, good of the world, this, blah. This is old school New York, Wall Street money, and I love and respect it, but that's what the fuck they care about. They care about how much they take home at the end of the year. So they need to put that capital to work. And what that means is as they're putting that capital to work, they're getting sloppier, right? They're either giving too much, they're creating bigger rounds because they want to give more capital so they can raise more, generate a bigger salary and paycheck for themselves. And I could do a whole nother video in terms of how money managers get paid, but what you need to know is that it's less important for them, the actual exits. What's more important for them is the on-paper returns and the assets under management. That's how money managers actually make money, regardless of what every single money manager will tell you, which is the exact opposite of that, because, of course, they're never going to tell you the truth. But, that's how they make their money. So for them, this $1.1 trillion is actually a huge liability. They have to put it to work. And so, again, by putting it to work, what's happened is you've made it incredibly easy for entrepreneurs to raise capital, and you've made it incredibly easy for these mega rounds, like the billions of dollars that pour into these late-stage unicorn companies, to inflate valuations and inflate metrics that are just never, they're not attainable. But we're in this euphoric state where, why stop the party? And that's the bigger point about today's story, is why this is so fascinating that this would come up today. Because every time you have a bubble, every single time you have a bubble, you could study this in any economics textbook, you could look it up online, you could look it up on YouTube, I'm sure there's a video about it. But folks, any time you have a bubble, you never want to stop the party. Nobody ever wants to stop the party. Why? Everything's so fucking good, who cares? Pre-housing crisis, who gave a shit? I don't care. Money managers are happy, right? Or the mortgage brokers rather are happy. Guy making $30,000 a year, living in a $3.3 million home, he's happy. Nobody cares about the underlying truth, which is that, God forbid, one little thing goes wrong in this economy, this whole thing is going to fall apart, it's going to collapse. That's every single bubble. And if it doesn't sound familiar to you today, it should, because that's what we're living in with the world of startups and venture capital. And so the fact that you have the most respected global news organization for business in the world coming out with a story like this today, and finally admitting to the fact, finally calling out the fact that, wait a minute, let's take a step back. This whole venture capital thing could be a huge bubble, is fascinating. Because we've had people say it before, the CEO and founder of Social Capital, right, who was basically blackballed from Silicon Valley when he said, guys, wait a minute, we're basically running the world's largest ever legal Ponzi scheme here. Right? The folks that have gone on to call out venture capital, like myself, that have been blackballed from that community. Right? Thank God I'm an East Coast New Yorker. I wouldn't survive in Silicon Valley these days. I've lost a good bit of friends. I've lost a good bit of venture capital friends. Because nobody ever wants to listen to the whistleblower. Nobody ever wants to pay attention to the person that's saying, wait a minute, let's take a step back and see what's going on here. And folks, what we have is we have these highly toxic organizations that are so dependent on this cheap capital and this dry powder that has to be deployed that they don't necessarily have to care. They don't have to focus on the underlying business. They have to focus on the overarching next fundraise. That's the Silicon Valley playbook today. Don't worry about revenue. Put that aside. Don't worry about profit. Worry about monthly average users. Get your daily average users up. We're going to take this one to Kleiner Perkins. We're going to get it funded. Once we get Kleiner Perkins, we'll get this firm, this firm, this firm. Boom. We'll be good to go. We'll have $2 billion. We'll be good for at least another 5 years, which is bullshit because they do another raise a year and a half later. But that's the Silicon Valley playbook today, right? And it's a playbook that we describe to our clients as one which is, it's a path you can take, right? It's a path that, plenty of people have taken, and sad truth is most fail because of the survivor bias. Those that don't fail, there's a select few that get very rich off it at the expense, oftentimes, of the employees with stock options and the retail investors get stuck holding this junk paper. But the top 30 or 50 executives at that company will make a lot of money. So it's definitely a path that's doable. It's a path you can take, but it's one, like I said, that we warn our clients that is explosive. You're playing with explosive material the whole way up. You're holding this match, and you're balancing in this hand this rocket fuel, and you're looking around for the rocket to light, right? And sometimes they find the rocket, and they put the fuel in, and then they put the match, and it goes off, and they're like, oh my God, we did it. But more often than not, either the match goes out and then they have all this rocket fuel, and this rocket fuel ends up expiring worthless, or the opposite, they run out of the rocket fuel, still have the match, but by the time they find the rocket, they're out of rocket fuel. All right, and so that's what the Silicon Valley playbook has dictated to some of the entrepreneurs today. And in fact, we've kind of taken a viewpoint of advising our clients, if you're already on that path, well, you're kind of stuck to continue in it, based on how far along you are, because you've started down that path. It's very hard to get off of. So the best thing that you can do at that point is look for an exit strategy, an acquisition plan, an IPO, and some will be successful. But really, what we've been trying to advise our clients on mostly in light of this news that not just we are putting out today. And thank God we've been vindicated today, folks. I mean, this is a huge victory lap for us at Startup Financial News, saying that, wait a minute, do we have this venture capital backed bubble for 2 years with people laughing at us, sending us hate mail, leaving us bad reviews, saying, oh, they're so negative, so pessimistic. This is a huge sigh of relief for us that CNBC is finally backing us up here and saying, wait a minute, there's something going on that's not quite right. This is huge. And again, one of the things, the takeaways that we should be looking at as entrepreneurs, as startup founders, as CEOs, and even as outsiders that are looking in, or employees that are looking in at these startup companies, what we need to be looking at is kind of what is our hedging strategy, right? How do we protect ourselves in the event of an economic downturn, right? Because right now, we're not sounding the alarm. We're not saying the party's over. We're saying the party's going to be over soon. It's not over yet. We said it on the Saturday episode. We probably have a good 3 to 5 years, if we're lucky, of boom that will continue. It could be less than that. So I don't want to be too ambitious on my statement there. But regardless, the takeaway for us as entrepreneurs is to say, okay, how do we plan for that? How do we operate today, knowing what's going on? There is this 1.1 trillion that's still going to be deployed, but how do we plan for tomorrow, right? So how do we play today? How do we plan for tomorrow? Right, so we play today based on the current environment. We plan for tomorrow by anticipating the worst. And say, okay, well, if I know what's going on, I can set up a strategy so that I am safe when that happens. For our clients, typically, what we try and explain to them is that you might want to take a slower growth path, right, and be more in line with what Silicon Valley has so unfairly labeled a lifestyle company, meaning that your organization is not going to be worth $1 billion in 5 years. Right? Somehow Silicon Valley and all their cover-up stories of how good they are for the world and how much they're changing everything have managed to manufacture this narrative that, lifestyle companies are the bane of their existence. Right? And a lifestyle company, them is a company that's going to do $20 million in year 2 and take home $3 million in profit for the shareholders. They'd rather your organization do $100 million with $80 million in debt on the books at a loss of $10 million that year. If it sounds ass backwards to you folks, it is. Because from a business standpoint, it is ass backwards. For them, it's not. Because if you remember, for venture capitalists and money managers, what do they want? They don't care about you. They don't care about your business. They want more assets under management. They want to take home a bigger management fee. If you ever wonder about any motivation on any kind of Wall Street, on any kind of money manager, any kind of venture capitalist, anybody that has anything to do with the financial system, it's always about the fees. It's always about the fees. That's all Wall Street is. Wall Street has been and always will be about the fees. And venture capitalists are not far removed from Wall Street. So just think about that. Think about that. And that does a lot to dispel and explain why we're in the situation that we're in. So again, the takeaway here is to note that if you've been a long-time listener to the program, you've probably already started to plan for this stuff because we've warned you about it for the last 1.5 to 2 years. If you're a new listener, if you're just subscribing to us on YouTube, if this is the first video you watch, please know that we're not just a program that sits here and makes up news based on viewpoints. This isn't a YouTube show where it's pulling stuff out of thin air. We check the major news channels, the major news stations, the major publications, right, from the Wall Street Journal to CNBC to TechCrunch to Bloomberg to Fox Business to CNN Money to everything else that exists, right? And we pull the most important data information for you, for us, the entrepreneurs, to understand and have a show, a program that's all ours, that's our own, and that takes away these key highlights that we need to know so we can better run our businesses, our organizations, and plan for tomorrow. Because as we've said so many times on this program, entrepreneurship is about seeing a situation today 5 years out, right? It's about seeing a trend. It's about seeing where this thing is going. It's about attaching yourself to this thing because you know it's going to be successful, right? It's about trying and failing, but it's also about succeeding. And the way to succeed is to be better informed. And that's what this program is all about. And today, I think you can see, especially if you're a new listener or a new viewer here on YouTube, that, this is not stuff that we can make up. There's no way around it. This is stuff that's in the major news publications. This is the CNBC story today that we're covering, folks. There's no way around it. And we'll share a link to the story. I don't know if there's a link to this because it's a newsletter, so if anything, we'll share a link to the screenshot on the YouTube channel. So if you're listening on the podcast, just pop on over to the Startup Financial News YouTube channel. Literally just type in Startup Financial News on YouTube. It'll pop right up, same cover we have on the podcast, and you can find this episode there. But, folks, what a day for us here. Again, this is not something that we like to celebrate here at Startup Financial News. We didn't like celebrating our calls on Blue Apron or on Snapchat. We don't necessarily relish in these victory laps, but we have to acknowledge them nonetheless. It's good for our ratings. It's good for our program. When a major global news organization, especially one of the most respected in business, picks up a story that we've been covering for almost 2 years now and puts out a piece like this that's just so groundbreaking. And I'm telling you, folks, if you have the time, it's worth it. It's a 2.5-minute read. If that, read the story. Especially if you're an entrepreneur, you have to read the story. Because the metrics, the data that it goes into, the way they cover the potential bubble that we're living through right now, fascinating. Fascinating. And just so you folks know, again, that's what we do here at Startup Financial News, is take real world news and take away the highlights and the keys, the most important facts, the most important data, and give it back to you, the entrepreneurs, give it back to us, the entrepreneurs, so that we can make decisions on that and then make heads or tails of the situations. Sometimes we do so by bringing on guests. We've had phenomenal authors, we've had phenomenal business people, phenomenal venture capitalists, phenomenal investors, phenomenal entrepreneurs. And you'll see plenty more of that on the YouTube channel. The podcast already has a lot of that, so if you want to go back through some of those landmark episodes, you can go ahead and do so, especially on our website, www.sfnshow.com, or you can just search by guests. You can see some of the big name guests we've had on there. We've had people from the FBI, we've had famous investment bankers, famous investors, famous entrepreneurs. Basically, have run the gamut over our last 2 years on air of the guests we've been able to feature. And, this is going to be a busy time for us, because this is one of the main stories and themes that we've been covering for a long time here on Startup Financial News. And so to be vindicated today, to be backed up by CNBC, is huge. But you can expect plenty more from us. We've been here all the way through. We've been here with you, covering this story, covering this potential bubble, this potential correction, recession, whatever you want to call it, that's manufactured by entrepreneurs, venture capital in the world of startups in Silicon Valley. And we'll be here not just continuing to cover it, but as we see it play out as well. That's our promise to you. So going to end the show there on that note, folks. Again, today's been July 22nd, 2019. I'm your host, Julien Meyer. This has been another episode of Startup Financial News. I want to thank everybody for tuning into the podcast. I want to thank everybody on our YouTube channel for subscribing and viewing this video. And if you have any entrepreneur friends, just like we ask on the podcast, please just share the video with 5 of your entrepreneur friends. Something in here might help them save their business, might help them avoid a pitfall that I've made in the past that they could have made, that other people can learn from, because that's what entrepreneurship always used to be about, and we're trying to make it again as kind of this fraternal order of sharing information amongst business people so that we can make better collectively informed decisions and build bigger, better, more sustainable businesses. So, folks, once again, thank you for tuning in. I'm your host, Julien Meyer, and I'll be right back here with you for another episode of Startup Financial News shortly. Take care.